All right, so now we're going to do a debrief of a sample script, and we're going to be doing an LC first. So this was task if. And we're just going to do a quick read through. So the candidate, this particular example, the first point there was the revenue and EBITDA is based on the forecasted figures and not the most recent figures, and this is incorrect to determine the maintainable EBITDA. You'll see there that we've marked that as a sort of incorrect, not that we are counting ticks here, but just um, it is not incorrect to use maintainable, to use forecasted figures for an EBITDA valuation. One can use forecasted figures if the forecasted figures are a best representation of the future. So that's not correct. And then it says the EBITDA figure should be normalized to limit once-off transactions, ownership change, and discontinued operations. That is eliminate once-off transactions. Yes, is true, but ownership changes and discontinued operations is probably something that one would take into account in the multiple. And also, probably in this context, why that was not a valid point was that it didn't apply to the context of the question, of the scenario. It's a sort of like theory that's being dumped. The same with the amounts that have not been normalized by the extraordinary amounts paid to shareholders for dividends, normal loans, and replacement of teacher costs. So, but which amounts are we talking about? We're talking about the EBITDA. Dividends, for example, is not even taken into account in earnings before into EBITDA. So, and this is non-operating assets are assets that do not form part of the value drivers of the company's core operation. So, again, that theory is not applying to the actual calculation that was given. Okay, so far in terms of we think what was asked, it's apply your mind to the methodology, the assumptions, and the valuation result, as well as any other issues. Like none of this is really hitting any of those key points. Then it says therefore remove income and expenses which are of a non-operating items identified. Again, too theoretical. Tax should be removed from all the adjustments, added back and included for adjustments removed. Again, too theoretical, and in any event, the starting point is EBITDA, which is before tax. Then candidate goes again into just once normalized, this is done. So it's a lot of theory dump. The EBITDA was not justified for growth, for risk levels and growth prospects of the company. Needed the candidate to be more specific, but here under the following, there should be the multiple should be adjusted as follows. And there we start to get into actual specifics that could be appropriate to the question. So listed versus unlisted, the growth rate. So that is specific, more specific to the question. And then it says the multiple should obtain a positive effect for positive difference identified and vice versa. Theoretical. Excess cash should be removed from the cash and cash equivalents added back. But what we needed, there's a discussion of, is that cash presented excess? No justification for the value to be derived. This figure should not be included. Getting to the point, but the reasoning behind the point is why it's not included is because it's a post-acquisition matter. The online model doesn't hold substance and it's not effective and therefore cannot be included in the valuation. That on its own is not true. So if we were valuing EOS and they on their own had a plan to bring an online model, then it would be totally appropriate to bring the online model into account. The reason why in this context we don't bring in shouldn't have brought in the online model is because it's a synergy that would not exist for EOS on its own, and we only need to value EOS, or only should value EOS at this point. This is the value as it stands. Is overvalue and adjustment will be required as above, which is the following is just more summaries. So if we look at in terms of what was expected for competence, or what we would have liked to see for competence, the candidate had some good issues around the multiple. So discussing, what that the multiple should have been adjusted for. But when it comes to actually probing whether the EBITDA as a rand value was appropriate, they were too theoretical. They didn't probe, perhaps that your forecast revenue and your the price of tuition fee and the number of students, that was not reasonable in this context. So that discussion and that was missing. And then other than, yeah, as I said, the multiple was there, but there wasn't really, they're not picking up good errors and other issues as to why the methodologies may not be appropriate, and just some strategic factors or qualitative factors was quite missing in this response. And so therefore we can see pretty much only the multiple was well addressed, and so this candidate therefore would get an LC. All right, if we move to a C response, okay, the candidate had some talk about the pros of the methodology, and again, this was theoretical and probably not necessarily correctly applied. So the pros of EBITDA can be represented as a school's ability to generate cash as non-cash items are removed from the operational profitability. That's not entirely true. For example, there are certain non-cash items that could still be included. This is not a for example, a discounted cash flow valuation where we remove non-cash items. There can be non-cash items that can be included in this valuation. So and then also using EBITDA considers forward-looking financial performance, but it also considers backward-looking financial performance. And the interest could make it look as Elgin has more money to pay interest. In reality, this could be very different. That is not a con because remember, we deduct debt. The model does not take into account changing working capital. I mean, that on its own does not mean that it's a bad technique, and in effect, the working capital plays itself out in the earnings. So that was not entirely true. And EBITDA of similar companies have very different risk profiles, and adjustments made to the multiple are subjective and made it appropriately account for the vast different risk profiles. So that is somewhat true, but not necessarily a major reason why one shouldn't do a EBITDA valuation. Okay, but then, so the candidate didn't start off well, but then they get into the assumptions. So here in this, they probe the fact that the revenue is 7.6% higher in light of the pandemic. That's probably too high, especially since, the Midrand school and as evidence from the Midrand school that, many parents are experiencing financial difficulties. So it was good link to the pandemic and the current economic circumstances. Then also questioning this EBITDA margin, which seems aggressive. So again, realizing, well, you've used this in your calculation, but actually this assumption seems quite aggressive. So up until that point, we've seen like good questioning and probing and interrogating of the EBITDA, the RAND value. Then we move to the multiple, and this candidate talks about similar companies, which is good. Cura, Advertech, very good. And then also saying like why there needs to be adjustments. So adjusting for size, the lower end fee structure, and the geographical location. So far, very, very good discussion on the or probing of the EBITDA RAND value and the multiple. Then there was some shareholders have included cash, which is not correct, as cash are considered and they reduce the net cost to the potential buyer. So it's not wrong to have included cash and cash equivalents. What should have been discussed is that cash entirely, is it all surplus cash? The shareholders has incorrectly deducted the loan from the equity value. As this is a financial claim against the holders, it should not be added, and it should be added and not subtracted. Now it's a loan, so it's debt, so it's actually more correct to subtract it. Perhaps the bigger discussion would be, number one is it must be deducted at market value, or more of a high level is actually should it have been deducted at all. So neither added nor deducted, because it's probably part of equity because there's no repayment terms. And then similar to the earlier script about this additional value, it's the fact that they're saying it's incorrect, but the reasoning that it's incorrect, it's because it's actually synergy, and we're not valuing synergies when we're just focusing on EOS as a standalone company. Okay, and then this candidate had some good discussion about the valuation result and why it may be more appropriate to use the net asset value technique. And so some good discussion there about, it's a large campus, The school's operation is centered around the property. So some good discussion that perhaps one should have considered a net asset value. And then there's also some good strategic factors over here at the bottom. So, the previous owners are looking to retire. They might not have the best interest of the school in mind, the geographical location, as we said. So there are some good strategic factors that this candidate brings into their discussion as well. So if we just look at the comparatives, this candidate had a good probing of the EBITDA from a rand value perspective. It had a good probing of the multiple, and it had some good methodology assumptions that was appropriately questioned. So appropriately saying why net asset value was supporting factors, why that may have been more appropriate, and then also some good other strategic factors. All right, so you can clearly see why compared to this candidate was a C. This candidate in the end actually only really had good discussion around the multiple. And just in terms of a highly competent candidate, so what would this candidate have needed to have done to be highly competent? Pretty much what they have there, and perhaps some more higher order thinking factors like the discussion around, for example, the discussion around whether the cash is surplus or not, and that kind of discussion there would have been regarded as high level. I mean, the school seems to need cash, or schools at this time seems to need cash. So is that cash actually surplus? I mean, one would think that cash at this point for the school is actually operational. So that would have been good as a high level discussion. And then another high level discussion would have been this discussion around the debt, the shareholders loan. It actually has no repayment terms, and so therefore there's an argument to be made that it should just be part of equity, so not deducted or added at all. So those would be two high level factors, which in addition to what this candidate has there, would have probably pushed them into a highly competent grading. All right, I hope you found this helpful with the actual read through and the contrast of a C candidate and an LC candidate. Right, cheers everyone.